Thanks for tuning in to this episode of the Resilient Advisor Show. My name is Jay Coulter, and joining me for this episode is my friend Michael Guyad. This is part of a monthly series where we look at risk on versus risk off. Michael, we're in month 2, 2021. There's so much going on. I could start anywhere, but following your Twitter account, quite frankly, the lead lag report, I think there's some things we should get to first. Let's talk about the lumber-gold ratio and the implications that advisors need to be thinking about in their portfolio construction right now.
Yeah, so look, there's a lot of consistency that's happened in the last, several weeks here in terms of the way the markets have behaved. The lumber to gold ratio has been unrelentingly moving higher. Now, why is that ratio interesting? Because lumber is a tell on housing, gold is a tell on fear. And when you compare the two to each other, it actually tells you a lot about risk conditions. And the fact that you're seeing lumber prices do what they're doing and housing doing what it's doing is all suggested that the bond move is justified, meaning the sell-off that we're seeing in treasuries, the steepening of the yield curve. That combined with ongoing weakness in utilities, combined with a lot of the cyclical sectors showing outperformance, you do have this, I think, very one-sided, strong sort of reflationary behavior that's taking place. You had a moment in time there around the GameStop craziness where it looked like that might pause, but obviously they came right back. And a lot of the comments from Powell and from Yellen and sort of on the political side as well are all confirming the notion that, again, it looks like the policymakers are going to get their wish. You're going to get inflation running hotter than most people may think. Bond yields are starting to reflect that. So all the conditions are still suggesting risk on is there. The only thing I would caution advisors on is risk on conditions are here in terms of the short term, but they've also arguably they're reaching a point where they're kind of stretched, right? In other words, there is a point where the bond yields spike is going to be harmful. There is a point where bonds will be more attractive than stocks. There is a point where the lumber to gold ratio will definitively turn, and all that might lead to some kind of an accident in the stock market. But at least in the near term, it seems like bonds remain the far more concerning area to most investors than stocks.
Let's go a little bit deeper on that, specifically around the 10-year. So we've seen the pressure on bonds. Yields are going up on the 10-year. Where do you see that ending? Is there a ceiling given the amount of debt we're carrying in this country? And how should we be having those conversations with clients as financial advisors?
So look, I think what you really need to pay attention to when it comes to bond yields rising is not the absolute level of treasuries or necessarily the way the yield curve itself is steepening. It's if it's steepening at the same time that credit spreads are widening, right? So what's interesting about this move in yields here is that you have not seen junk debt spreads against risk-free yields widen, right? So in other words, there's a feeling that this is actually kind of healthy in the bond market, that it's a repricing of inflation, that it's not something that would suggest default risk is increasing in line with the rise in yields. I think if you start to see the yield curve continue to steepen, but then you start to see at the same time junk debt not participating, okay, in other words, you see widening in those credit spreads, that would be the first crack that would suggest that yields are getting too high. And probably at the same time, then you see some of these leading indicators like utilities, treasuries, lumber, gold also start to confirm a higher volatility juncture ahead. But the key really is to watch credit spreads. It's not so much to watch just the yield curve by itself.
So for the technicians out there, what type of spread do we want to keep our eye on where we should start to sound the alarm bells?
So one of the relationships I like to track in the lead lag report, which is the premium research service that I offer, is just a very simple ratio of the junk debt ETF, JNK, let's call it, divided by IEF. Not exactly the same duration, but you still got kind of the same sort of relationship. So when you compare that ratio to each other, rising ratio would mean junk debt's outperforming. Treasuries, falling ratio means the opposite. If junk debt's outperforming, that would suggest narrowing of credit spreads. So that relationship still remains in a pretty decent uptrend. I think if you start to see a breakdown in the J&K to IEF Treasury relationship, that would be suggestive of credit spreads potentially starting to widen, and that would be a warning sign against inflation expectations still picking up.
For podcast listeners, you can learn more about the Lead Lag Report by visiting leadlagreport.com. It's one of the best subscription services in the business. Michael, let's move on to copper. I've seen you tweeting about it here recently. How do advisors need to look at copper, and what are the implications as they're building out portfolios?
It's amazing. We've talked about the commodity move, I think, for a little bit of time here, right? And it's further confirmation, right, that you have cost push inflationary pressure building, right? And you're seeing that across the entire commodity landscape. Copper certainly trading at multi-year highs, and that would suggest that industrial activity is about to pick up. And again, that's consistent with lumber, that's consistent with oil, that's consistent with inflation expectations in general rising. For advisors, commodities are tricky because some advisors look at them as a asset class, some don't. I do think we're probably entering some kind of a cycle, maybe not a super cycle, but a cycle of some sort that really does favor commodities more generally against equities. But if you look at copper just from the standpoint of it being a signal as well as an investment, I think the market is clearly making it very clear, right? There is expectation increasing for a pickup in industrial activity, whether that's due to more stimulus or just sort of the sentiment around the vaccine and kind of things reopening globally is almost irrelevant. We know that it's happening. And from an allocation perspective, I would probably make the argument that commodities have more room to run relative to equities, that this is still a very early type of outperformance spurt here.
So I wanted to talk about commodities in general and allocating to them. But before we move on from copper, and you might not be able to see this on your screen, and podcast listeners definitely cannot, but looking at the Bloomberg Copper Subindex, it is well above its 50 and 200-day simple moving average, and the RSI is at 85. So does that have any extra implications for you as you look at copper and where it sits today at the end of February?
Well, I mean, look, we know that overbought can stay overbought for a while, right? And this is where I think time frame matters, right? You can be bullish and bearish at the same time, just depending upon which time frame you're looking at. You can make the case that commodities are also overstretched, which that would be consistent with the idea of credit spreads widening, right? If you get sort of a feeling that these inflation expectations are going to be problematic, given how much they've risen. But again, I go back to this sort of the short term and more intermediate long term. The intermediate long term case, I think, for commodities is, I think, there unequivocally, and I think there's a lot of underinvestment that's occurred. Short term, though, certainly they could be stretched, right? And that could be vulnerable. But if you're a real long-term asset allocator, you don't really care about the short term, right? You might want to wait. You might want a dollar cost average. I don't think commodities are an asset class you want to go very aggressively in as a percentage of portfolio, but somewhere that 5, 10, 15, almost like a alternative satellite asset class investment, I think does make sense because, again, it's been an area that's been left for dead for a long time.
Yeah, which is a great segue into allocating to commodities today. Michael, about 10 years ago, I was fortunate to work on one of the first commodity ETFs that launched. I was super passionate about it because I saw the implications. What I did not understand was the challenges of investing in a broad-based commodity ETF and adding it to a portfolio as it relates to performance attribution and, more importantly, performance drag. For advisors today that are building thoughtful portfolios and they want to add commodity exposure, what are some of the processes they should go through to capture returns from the commodity space?
So I think the way that the commodity exposure is constructed is very important, right? So there's two types of sort of commodity products: those that are futures based and those that are based on the actual underlying commodity, where things like gold or silver or some of the industrial metals will fit in, whereas some of the soft commodities that are future based, like corn or like oil, would sort of fit in there. The problem with the futures side of it, where you have to keep on rolling over these contracts, is you have this situation known as contango, right? Meaning that you have to keep on rolling over these futures contracts, and time is against you, which means you're never going to exactly replicate the actual current spot price of those commodities. So you can ameliorate that a bit by just looking for those commodity plays that are more in that sort of 2 to 3 month rollover time frame. Buy yourself a little bit of time in the way the structure is. But it is important, right? Because not all commodity products are created equally, right? And I think, as my colleague Dan Weisskopf likes to say, structure matters when it comes to looking at commodity products. There is a lot of value, I think, in a lot of the soft commodities which have gone vertical. There's a lot of value, I think, in the metals and the industrials, again, like copper. But I think you have to kind of just mix it properly. Oil is a little bit trickier, I think, in some ways, because oil is so directly tied to inflation expectations that really a play on oil is a play on bonds. I mean, it's almost one for one in terms of that relationship of oil prices to inflation expectations. So again, I think a mix. I think just be mindful of that contango, part of a commodity investment, and just sizing properly is the key to everything.
Do you think, and this was one of the lessons I learned from 10 years ago, that commodity allocations are really significantly more tactical than strategic? And it's something that needs to be the size exposure needs to be actively managed through it. Is that a fair assessment?
Yeah, I think so, because as the saying goes, right, the cure to price is price, right? So, as commodity prices rise, the assumption becomes, well, then you start kind of finding ways of releasing more of that commodity into the marketplace that floods with more supply, and you've got to kind of address that. I mean, if commodity prices just go up forever, depending on who you ask, maybe Bitcoin is a commodity that just keeps going up forever. I think that's kind of an important thing to think through. But again, I go back to, you can have these sort of tradable opportunities within these longer term cycles. So being tactical and strategic, I don't think are they can coexist, right? If you just have the right approach to it.
Yeah. Speaking of Bitcoin, so we've been talking with guests lately about the idea of a Bitcoin ETF. There's all types of opinions on whether it is A, viable, and B, whether it's something the market should even have. I want to play you a clip from Matt Hougan of Bitwise Asset Management.
People have been trying for a while. I think the first ETF application came in 2013 from the Winklevoss twins. The reality is, in 2013, there were lots of reasons why we shouldn't have had a Bitcoin ETF. There wasn't regulated custodians. The market wasn't well arbitraged. It wasn't very liquid. There was no history of audit in the space. We didn't know what all the risk disclosures were. It was a very early market. So it's not surprising that those early applications were rejected.
He has such a great lens on the ETF space and Bitcoin, given his career. What are your thoughts, given what has happened with applications so far, and where you think we could be heading as an industry in creating ETFs for advisors to use in allocations for their clients?
So my co-portfolio manager on the ATAC rotation mutual fund and ETF, Mike Venuto, who's a real industry veteran when it comes to ETFs, makes this point that historically Canada tends to move 6 months in advance of the US in terms of product launches, meaning that if you are seeing a Bitcoin ETF now start, which is live now in Canada, you're going to see it 6 months later here in the US, that there seems to be this consistent lag. So it seems plausible, right, that that's probably where things are headed, although it's kind of curious, right, because I thought the whole appeal of Bitcoin was to be off the grid in terms of trackability. Well, now if you're going to have an ETF, it kind of removes the purpose of Bitcoin from that standpoint, right, because again, you're in a fund that's your Bitcoin's meant to remove the middleman, and now you're putting in an ETF, which makes it the middleman, right? Which is kind of a kind of strange concept. So look, it wouldn't surprise me whether or not it creates increased demand or not, or whether it's a sign of intermediate top. I have no idea. It certainly seems plausible. I'll tell you, I've been ranting a lot on Twitter about uneducated speculation. And some people seem to think that I'm bearish on Bitcoin or on blockchain technology. It's not about being bearish. Consistently, time and time again, when you have the crowd thinking that it knows the future, something else is going to happen. I mean, that's one of Bob Farrell's 10 rules, in the short term, at least. And, all of this excitement around the accessibility of Bitcoin and all this excitement around all these corporations, and whether it's Tesla or any other that are putting them in their balance sheet, Square's recent purchase. I get nervous when I see so much excitement by the crowd that doesn't really understand that risk is still a thing, independent of whether it's Bitcoin or dollars. And I think at the end of the day, risk still matters more than anything else. And when you see everybody so certain of the appeal of Bitcoin, first of all, we don't know. We could see some kind of federal action that comes in, and we know that Yellen is not a fan of Bitcoin at all. We're already starting to see some of the rumblings of that, saying it's inefficient, which I think there's an argument to be made for that. So we'll see. I think this is a fascinating juncture, right? Because I understand fully the appeal of a decentralized currency. But as I noted on Twitter, hubris and overconfidence is decentralized too. And you can have Bitcoin go to 500,000. You have to tell me how it gets there.
In 1997, I was a rookie broker in a wirehouse bullpen, and we were not allowed to talk about internet stocks. We were not allowed to. By 1999, I had everybody and their brother asking me about how they could purchase shares of internet stocks. In the past 2 weeks, I've had my barber, my handyman, my unemployed friend all ask me about getting allocations to Bitcoin. That's not real analysis, but it just feels a lot like the same mania is there now that it's in the general public. Have you experienced any of that?
Yeah, so I actually had a cousin who is not investor savvy at all ask via text, and I haven't talked to my cousin in a while. Should I consider Ethereum, Bitcoin, or Doge? And I didn't respond, but it does. I think I look, and you can see this even on platforms like Clubhouse and the way that people talk about things when it comes to Bitcoin. There's this love affair with this, and I don't think people really understand what it is they're purchasing. And I got to tell you, it's also kind of a strange concept. So everyone's, is Bitcoin a currency? Okay, well, if it's a currency and everyone's holding it and nobody transacts with it, it's not really a currency. If you're just holding it, it doesn't create a dividend. It's hard to value. If you're going to make the case for the technology, that's a different animal, right? In terms of the peer-to-peer, sort of lending in the way that it's structured, right, as a business process in many ways, that's a different animal. But if it just seems strange to me if everyone is just kind of viewing Bitcoin as something to buy and hold, because it's going to go up. Okay, well, you still have to transact with it if it's a currency. Otherwise, it's just code everyone's sitting around and waiting on. So I don't know. It's a strange concept. I think, and maybe we're just in the early stages of it. And maybe I don't fully get it. And I'm sure a lot of people will say that I don't. The one thing that I know for sure is that history repeats in terms of some of these mania cycles. And I think that the complete obsession, and that's really the right word that some people have around Bitcoin and the way it's, to your point, kind of getting out there in the culture, I think is a problem for those that don't know what risk is.
Michael, I appreciate you coming on the Resilient Advisor Show. You're always entertaining and you have great takes. We'll see you at the end of March.
Much appreciated. Thank you.